Americans in their 50s and 60s have lost tens of thousands in their retirement accounts since the tariff shock started. This exact pattern has run before, and who survived it depended entirely on what they did in the first 30 days. Check this out.
If you're thinking about when to retire based on your 401k, you need to understand something about the advice you've been hearing your entire life, because it's about to flip. And right now, there's a toxic mix forming inside your portfolio that most people won't recognize until the damage is already done. Toxic mix. That phrase is showing up on trading desks right now. Hasn't been used seriously since the 70s. It means stocks and bonds falling at the same time. The two things your retirement is built on dropping together. When that happens, the safety net inside a 60-40 portfolio disappears. It happened in 2022, and it took 3.5 years to recover. The conditions that cause it are building again. But first, the flip. Your whole career, you've been a buyer. Every paycheck, every contribution, every employer match, you are putting money in. For a buyer, a down market is a sale, a discount. When your advisor said stay the course during every dip of the last 30 years, that was correct. Every dollar you contributed bought more shares at a lower price. Those shares recovered. You made money on the dip because you were buying into it. The day you retire, you become a seller. Every month you pull money out to live on. And for a seller, a down market isn't a discount. It's a permanent loss. The shares you sell at the bottom don't participate in the recovery. They're gone. You spent them on a medical bill in March. Stay the course was built for the buyer version of you, not the seller version. And nobody tells you when the advice flips. By the end of this video, you'll know what's actually hitting your 401k right now, why it's different from a normal dip, what the toxic mix actually is, and the one question that determines whether your retirement survives the gap between now and the recovery. Your account didn't get hit by one thing. It got hit by two shocks back to back in 12 months. Last year, tariffs pushed the S&P 500 into its fastest correction. The market barely recovered before February 28th, the day the Iran war started. First quarter of 2026, the S&P dropped 4.6%. Worst start through a year since 2022. NASDAQ down 7.1. The Dow fell more than 3,600 points from its 50,000 high. The ceasefire landed this week. People exhaled. Then today, Iran's parliament speaker called it unreasonable, accused the U.S. of violating three conditions. Oil started climbing again. Ship traffic through the strait has all but vanished. Goldman Sachs said yesterday the market may not have bottomed. They need three conditions met, and the third, stronger macro data, is unlikely soon. They raised recession probability to 30%. Blankfein, former Goldman CEO, said the fallout is going to last even if there's a resolution tomorrow. Eurozone inflation jumped to 2.5%. That's already in the data. The global inflation reacceleration that everyone assumed was over isn't over. It's accelerating at the moment. War compresses growth. That combination, rising inflation plus slowing growth, has a name. And it's the one word that connects everything happening to your 401k right now: stagflation. Your 401k is almost certainly some version of a 60-40 portfolio. 60% stocks, 40% bonds. The design is simple. Stocks fall, bonds rise. The bonds cushion the blow. That's how it's worked for decades. They're the shock absorber. It breaks when inflation shows up. When inflation runs hot, the Fed raises rates. Higher rates crush bond prices, mechanically, automatically. At the same time, inflation pressures stocks. Both sides dropping for the same reason. The shock absorber stops absorbing. That's the toxic mix. In 2022, it happened. Russia invaded Ukraine. Energy spiked. Inflation was already running at 5%. The Fed raised aggressively. The 60-40 dropped 17.5%. Worst since 1937. The only crash in 150 years where a 60-40 was more painful than holding stocks alone. Because bonds fell harder than equities in some periods. The cushion didn't fail. It made things worse. 3.5 years to recover. Goldman's read on 2026. The structural starting point is better. But here's what Goldman is doing with their own money. They deployed tail risk hedging, reduced their equity exposure, raised recession odds. The institution telling clients the baseline is fine is hedging its own book against the scenario where it isn't. When the people giving the advice are protecting themselves from the advice, that's information. The variable is whether inflation reaccelerates enough. Tariffs pushing consumer costs up, diesel at $5.64 nationally spiking freight through every supply chain, energy surcharges on every channel. CPI could hit 4.4% by summer. If it gets high enough, bonds stop cushioning. Both sides of the 60-40 bleed. The toxic mix is back. That scenario hasn't fully arrived, but every input is in the system. Now here's the concept. It has a name: sequence of returns risk. It sounds academic. It's the most practical thing you'll hear this year. The long-term average return of the stock market is 10% a year. That number is real. Over 30 years, the market goes up. Drawdowns get absorbed. That's why stay the course works for a 30-year-old. Time smooths everything. But that average is meaningless if the worst years happen to land at the exact moment you start taking money out.
Hey everyone, real quick, and this one's important. When the model breaks during a war and debasement cycle, the question becomes what actually preserves purchasing power. The Bitcoin and security bundle covers that. If you're interested in looking into how to safely invest in cryptocurrency like Bitcoin or anything else, links down below for a package of 2 courses that build a program that builds safety and security around a new investment like crypto. Check it out, links down below.
2 people, same portfolio, same balance. Person A retires into a strong market. First 2 years, up. They're selling shares, but at high prices. 20 years later, they have more than they started with. Person B retires into a downturn. First 2 years, down. They're selling the same number of shares for the same bills, but at much lower prices. They sell more units to generate the same income. Those units are gone. When the recovery arrives, they aren't there. 20 years later, person B runs out of money. Same average, same allocation. One retires comfortably, one goes broke. The only variable was which years came first. That's sequence of returns risk. It is the single biggest financial danger for anyone within 5 years of retirement. And it doesn't appear in a single brokerage email telling you to stay the course. Christine Benz at Morningstar said it during this exact moment. The conventional wisdom is freeze. No one do anything. But you may actually need to take action. Not panic selling, not timing the market, evaluating one thing. Do you have 5 years of spending in cash or short-term bonds that you can live on? Can you live without selling a single equity position if the market stays down for 3 years? 5 years means calculating actual annual expenses. Multiply by 5. That number lives in cash. T-bills, money market, liquid, boring, accessible. If you have it, the drawdown is noise. Every equity position is there for the recovery. If you don't, here's what the math actually does. You retire at 63 with 800,000. You need 48,000 a year to live. Market drops 12% in year 1. By December, your balance isn't 800 minus 48, it's 656. The withdrawals ate 144,000. Market drops 6% in year 2. End of year 2, you're at 560. Started with 800, you've taken out 96. The other 144,000 vanished. You sold the shares that would have recovered, you'll never get them back. Market recovers 20% in year 3. Your coworker rides it back, you don't. Your base is 560, not 800. 20% of 560 is 672, minus another 48 for living, you're at 624. 3 years in. Started with 800, sitting at 624. That's the math that turns a 30-year retirement into a 22-year retirement. That's selling the lake house. That's telling your wife the care plan doesn't work. That's the phone call to your kids you never wanted to make. So build the cushion. 5 years of cash. Do it this week. But here's what the cushion doesn't fix. The cushion is denominated in dollars. The 401k is denominated in dollars. Every share is measured in a unit losing value. Inflation didn't start with the war. It was running before any of this. The dollar's lost 96% of its purchasing power since 1971. The forces pushing it lower, 39 trillion in debt, those aren't going away. Those are structural. Those are the system. The toxic mix is a symptom of something underneath. Stocks fall because economy slows. Bonds fall because inflation rises. And the dollar is getting lighter every year regardless of which direction the market moves. The market recovers. Your balance goes back to 800,000. But 800,000 buys less than it did when you put it in. Your 401k was sold to you as the American retirement plan. Contribute every paycheck, get the match, stay the course, retire with dignity. For decades, it worked because the dollar was stable, inflation was lower, and bonds paid you something real. That world is ending. Maybe it already ended. The system is debasing the currency to manage a balance sheet that has no other exit. The 401k doesn't exist outside that system. It's inside it. Everything is priced in the same dollar, getting lighter. The cushion protects from selling at the wrong time. It doesn't protect you from holding the wrong unit of measurement for the next 30 years. Build the cushion this week. But the longer question is, what do you actually hold when the system is breaking? That question doesn't have a 6-word answer. It has a strategy. It requires studying what actually holds value during a debasement cycle, not guessing, studying. The people who came through declines intact weren't lucky. They understood the mechanics before they finished running. If you haven't started, you're late, but you're not too late. The market will do whatever it does. The ceasefire holds or it doesn't. Goldman hedges or it doesn't. The toxic mix arrives or it doesn't. None of that is yours to control. The cushion is yours. And the decision about what you hold beyond the 401k, beyond the system that sold you the plan, that's yours too. But only if you make it before the math finishes. And the math is running right now.